interest rates have got to go easier and all the rest of it. I mean, I agree with that in a sense, if we had the opportunity. But the reality is that America is trying to fight a war with a debt trap. It's in a debt trap. It rolls up the interest. I can easily see U.S. Treasury bonds, priced at sort of 10 to 15 years out, looking at 15% and more. What's that going to do? I mean, the dollar is going to collapse. The question, I don't think, is will it or won't it collapse? It's when. That is really what we're now seeing. We're coming towards an end game, and we can see this rising. So it's a very dangerous situation.
In today's news recap, silver leads the breakout for gold, but resistance looms. Soft U.S. retail sales data has rekindled hopes that the Fed may have more leeway to cut rates sooner than they're letting on. This has provided a nice bounce for metals, with many now waiting to see if momentum can be sustained when U.S. traders return to their desks. Silver is up 2.3% and at a 9-day high after breaking back above $30 near the end of the session. After a bit of a delay, gold is now catching a bid and is up 0.6% ahead of the European Open. Given we're hours away from 2 central bank meetings, sentiment can easily shift. If metals are rising on dovish expectations for the Fed, they could potentially give back some of those gains if the Bank of England or Swiss National Bank are not as dovish as hoped. Silver technical analysis. Current high has stalled around trend resistance. This is a bullish breakout from the consolidation around the 50-day EMA, so overall it appears constructive for further gains if or when resistance is cleared. The 1-hour chart also shows that the daily high lands around the prior retracement, which adds weight to the case for an interim top. Lastly, the daily RSI is now within overbought territory, along with the 4-hour RSI. In the hours before silver broke out, gold looked like it wanted to break higher, and if it did, it was not a breakout to be trusted. The price action of the last couple of hours has done little to sway this opinion. Gold's breakout is lackluster in comparison, meaning bulls are driving prices higher with less conviction. With the monthly pivot point just above $2,350, any move towards this level could attract bears seeking to fade the upward momentum. Now, we'll show you the latest clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
The short exposure was actually a very successful raid, if you like, on the stupid longs. And that's all it was. And of course, now we're sort of recovering a little bit. We've got the Fed meeting this evening. It's not expected that there will be anything coming out of that. However, what's interesting is that Lagarde lowered the ECB's deposit rate by 0.25% last week. Now, not that I've got a lot of respect for Lagarde as a banker, but I would doubt if her office hadn't been talking to opposite numbers in the Fed, in the Bank of England, Bank of Japan, so on and so forth, before taking that decision. So, it could indicate that these guys are getting together to try and force the rates down without, hopefully, from their point of view, encouraging a resurgence of inflation. But that ignores actually what inflation is. It's a falling purchasing power in the currencies, which is actually why gold appears to be rising. It's not gold rising, it's these currencies falling. And, people so often make the mistake of, thinking that the People's Bank of China is buying gold. No, they're not. They're selling dollars. This is something that has not been covered in the mainstream media at all. The end of the 50-year agreement whereby Kissinger and Nixon agreed with the Saudis to, provide them with defense, security for the nation, in return for which all oil would be sold in dollars. That agreement was a 50-year agreement. It ended on the 9th of this month. And so we're in new territory. And we know that the Saudis have probably broken this already anyway, because they've been selling oil to China. As I understand it, the settlements have been in yuan, at least some of them anyway. So I think that this is actually a major point. I mean, the oil for dollars really was, if you like, the ground upon which the dollar has stood since 1974. That's now gone. This could well accelerate. It is very, very concerning. There is another aspect in this, and I'd be interested in your thoughts too, and that is the demand for gold. We've been talking about it migrating from west to east, and particularly China, which is the Hotel California for gold, really, because it needs it as an industrial metal. But India has become a major buyer, really, again, for industrial purposes, because India is ramping up its ESG credentials. The government is encouraging and I think even subsidizing the production of photovoltaic cells. And so, I mean, Reliance Industries, one of the major conglomerates in India, has recently opened a factory which produces 5 gigawatts of photovoltaic cell output. Needs a lot of silver. And so where do they go? I mean, it looks to me like they've been standing for delivery on COMEX, where, I think over 1,500 tons has come out this year. We're talking about quite serious quantities. And, stocks in the vaults, free stocks as opposed to stocks which are actually sort of held by ETFs or other serious holders, as it were, long-term holders, that liquidity is actually diminishing very substantially. So there's a huge squeeze. And of course, nobody on the short side in the paper markets can close their positions. It is actually, I think I can see the possibility of a crisis in the bullion banking community. I mean, not just on silver, but also gold, where they cannot close down their position. And if you look at the producers on COMEX, when we had the spike up to $1,900, was it September 2011 or 12? The producers category was net short of about 200,000 contracts. This time, they're short of less than 50,000. So you can see that the burden is actually on the swaps, and they can't escape from it. They can't turn around and tell the miners and so on, look, sell your production forward so you can guarantee your cash flows, which is, the old story that they do, because, the miners aren't having it anymore.
In today's market recap, big silver rally of 2024. Stalled, why and for how long? The big silver rally stalled because speculators were unanimously long. The market does not reward consensus trades. The silver market will require less speculators before moving higher. Silver experienced a solid bull run in the period March to May 2024. Right before hitting silver's first bullish target of 34.70, the big silver rally 2024 stalled. Why? And for how long? Just to be clear, silver will hit $50 sooner or later. The question is when exactly. It's a matter of when, not if. Silver experienced an excessive number of speculators betting on the long side in the silver futures market. This, as said in our premium silver alerts since April, would prevent silver from moving much higher in the short to medium term. Speculators finally are giving up. Finally, they have been hit undoubtedly during those days with larger red candles. Remember, this is a futures market indicator. The leverage is insane when holding futures, so a 5% one-day decline has tremendous effects on a portfolio holding silver long futures. It's too early to get excited, but speculators leaving the arena is the prerequisite for silver to move higher. Lovely development, likely just the beginning. There will be a point in a few months where speculators will be hating silver, which is when we'll love it. Now we'll show you the best clips, but first, smash the subscribe button and turn on notifications. Enjoy the episode.
The short exposure was actually a very successful raid, if you like, on the stupid longs. And that's all it was. And of course, now we're sort of recovering a little bit. We've got the Fed meeting this evening. It's not expected that there will be anything coming out of that. However, what's interesting is that Lagarde lowered the ECB's deposit rate by 0.25% last week. Now, not that I've got a lot of respect for Lagarde as a banker, but I would doubt if her office hadn't been talking to opposite numbers in the Fed, in the Bank of England, Bank of Japan, so on and so forth, before taking that decision. So, it could indicate that these guys are getting together to try and force the rates down without, hopefully, from their point of view, encouraging a resurgence of inflation. But that ignores actually what inflation is. It's a falling purchasing power in the currencies, which is actually why gold appears to be rising. It's not gold rising, it's these currencies falling. And, people so often make the mistake of, thinking that the People's Bank of China is buying gold. No, they're not. They're selling dollars. I just think it's possible that the central bankers might be trying to get together to force a small fall in interest rates. They'll never get more than that. Because the whole system is just tottering on the brink. I mean, you've got, the commercial real estate business in America. We've got all these things, zombie companies. We underestimate the degree of zombiness, if you like, in our economies, which all come about from suppressed interest rates. On top of that, I mean, the central banks themselves are deeply underwater in terms of real losses. Embarrassingly so, when you expect them to underwrite the commercial banking system, which is over leveraged. The easy way out is to try and get interest rates down. I just wonder whether we might see a slightly more concerted attempt in that direction a bit sooner than we probably expect. But, if they do it, I mean, gold will go through the roof, I think, because the inflationary implications are just, just unreal. Just crazy. Well, I don't think they're trying to sort of accelerate the decline or anything like that. I think they're genuinely frightened of the position they find themselves in. For years we've been talking about kicking the can down the road and so on and so forth. And, the can is not getting kicked anymore. It's not going anywhere. I think that people in authority are genuinely frightened of the situation, which they find themselves having to deal with. This sort of, we can all see it, which is why we all turn around and say, well, they must be conspiring to do this or that or the other thing as the only way out. But that sort of speculation, I think, is wide of the mark. I mean, just bear in mind these guys. There is really nothing they can do. They don't understand necessarily how they've got themselves in this position because, they're pulling the levers, the economic levers, and nothing is happening. But it should be happening. They're still in that sort of mode. They're not sort of thinking, why doesn't it happen? Yes. I mean, we pull the lever. Why does it not work? We ought to rethink this. They're not at that stage at all. And they actually don't have the time to deliberate on this. And it all goes back to, if you like, the sort of socialism versus free markets. I mean, okay, free markets, not necessarily perfect, but they're bloody sight better than what we have. And that's actually what it boils down to. So, you can be a central banker and you can understand free markets as much as you like, but can you persuade your politicians to do so? No way. I mean, I actually spent a day with the central bank in Scandinavia. I won't say exactly which one, but and I was talking. Really, I was called in to talk to the board, the foreign exchange department, the payments department, all the rest of it, and give an overall presentation to the bank. And I told them that interest rates are going to rise because the banks are no longer lending. Which basically means that the price of credit goes up. I told them about the debt trap that the US is in, and this country's government economics, government finance position is actually very, very good. But I said, look, it doesn't matter because, if the dollar goes down, we'll go down. So that is, the dollar is the king rat of currencies. And they understood that. Then there's another conversation, which was fascinating. This government has very little debt. I mean, we're looking at a debt to GDP in the order of about 35%, something like that, which, compared to us, over 100. I mean, that's dreamland for us.
Yeah.
Anyway, but the problem is that it's the private sector which has got the debt. And they have had a policy of restricting rentals, the rental market. So there's virtually no rental market at all. So if you want to have a roof over your head, you've got to go out and buy property. And the result is that, particularly with, the sort of zero interest rate situation, the leverage, the financial leverage that people are in is just absolutely enormous. We've got the same thing here, the same thing in America, same thing everywhere. It's a point worth making. We get a rise in interest rates because of the inflation situation, because of the government debt situation and the requirement to fund that at anything up to over 10%, maybe 15, maybe even 20%. That is going to basically bankrupt home ownership where mortgages are involved. And if mortgages are not involved, the collapse in the values for property, for residential property, will spread to those who don't have mortgages. I mean, this is not going to be a nice situation at all.
What do you think of Alasdair Macleod opinion? Do you agree with him? Do central banksters know how to handle the economy, or are all of them clueless? Post in the comments section down below your honest opinion and share this video with a silver bug. Send a super thanks if you find our recaps valuable, and make sure that you watch this video right here because you'll like it. I see you on the other side.